You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at OptionAlpha.com, working every single day to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So thanks so much again for tuning in today. On today's show, we are going to be talking about how market direction becomes irrelevant when you average down. And I'm not necessarily talking about averaging down in the price that you pay for a contract or the credits that you collect. It's really this concept of averaging down and around wherever the price of an underlying security goes and increasing your trade frequency, which means that market direction over time becomes more meaningless to you. So let's take one step back even before we kind of jump into what I'm talking about on the option side and just talk holistically about why trade frequency and high probability trading is so critical. And I think the idea that people miss time and time again is this idea of sequencing risk. It's this idea that we don't know, even in a high probability system, when we are going to be faced with a sequence of either favorable trades or not favorable trades. In fact, a lot of times people will ask and they'll say, Kirk, I want to see your last 10 trades, or I want to see your last 100 trades. And I will decline that and say it's irrelevant because the last 10 or 100, or pick a random number besides all of the trading that we've done, which is why our performance page shows all trading that we've done, not just the last 10 or 20, could drastically underestimate or overestimate what our performance has been. And it's just due to random occurrence because I don't know what the next 10 trades are going to be, right? I have no idea, if the next 10 trades are going to be 7 winners and 3 losers, or 3 losers and 7 winners. And so it's this sequencing risk that nobody accounts for in this business. And most people fail to truly understand. Because what people see is they see, let's say, just to use a really basic example of this, but let's say you have a 50-50 system, right? So a 50% chance of winning, a 50% chance of losing. And even if you win, you make $1. If you lose $1, right? Totally, basically zero-sum game. Well, even in that system, you could considerably have wildly different payoff diagrams over the course of a year or 2 years or even 3 years. You could have a string of winners that could be 17 in a row that are just totally out of left field, like a 4 or 5 standard deviation type win rate. You don't know what the sequence of returns are going to be. So, 2 people flipping a coin, 50% heads or tails, they pay $1, lose $1. At the end of 100 flips, their outcomes could be drastically different. And so what people do in the market, though, is they see people doing this. They don't see them doing the 50% trades, but they see people making trades and they randomly become profitable. And then they think, okay, that's how it should be. That if I have a 50% win rate, that means every other trade will be a winner, or 5 out of every 10 trades, or even 50 out of every 100 trades will be profitable. But it's just not the case. The random distribution of results that's caused by probabilities can sometimes be very, very strange. And so what people do is they try to assume that these regular calculations of trading expectancy take into account random sequencing, but they don't, because sequencing is random. We don't know what the distribution of profits are going to be. We just know if you make enough trades, you should start gravitating towards the expected probability, right? That over enough flips of a coin, you're going to hit 50% heads and 50% tails. We don't know when that's going to happen though. So when we take that thought process and start to apply it to the markets, the biggest problem I see people doing in this business, not only in the options trading business, but generally just in all investing, is that all of their trades are focused on a few opportunities per year. And when they focus all of their trades on a few opportunities per year, it makes those dates in time critically important to your success. In fact, it's the only thing that's critically important to your success. is, are those dates in time when you decided to make a trade randomly going to be good dates or bad dates for the underlying that you traded? So let's use a very basic example of this. If I were to tell you that you only had one opportunity every year to invest all of your savings that year in a stock or some ETF or some market, how important is that one single date to your long-term success? It becomes insanely important. If you randomly pick the top of a market, that could cripple you for the rest of your life. If you randomly pick the bottom, you look like a rock star and a genius because you randomly picked the bottom. And what people do all the time in the options business is they choose to either enter trades or not enter trades. And what they're effectively doing through their actions and through their choice is they're making the time periods that they do end up trading, whenever they procrastinate long enough and then make a trade, those time periods become more and more important. And the randomness of those time periods in those markets then detrimentally impact their performance. And they then chalk it up to the strategy doesn't work, the system doesn't work, Kirk, you're a scam, none of this stuff works, right? But you're crippling yourself by allowing the market and its timing to be the random factor that you can't consider. So what I suggest people do on the furthest end of the extreme spectrum, and then we'll start working through the middle, is increase your trade frequency so much so that wherever the market moves, so do you. And that's probably the easiest way I can explain it, is that if the market moves up by $1, then your next entry is all your strike prices up by $1. And if the market moves but down by $1, your next strike prices are all down by $1. And so when you cut down your trade entry over the course of a year into very small, very consistent bite-sized chunks, then what happens is market direction becomes meaningless over a long period of time. Now, not to say that the market direction is not going to sting and it's not going to hurt and you're not going to go through periods of drawdowns or setbacks. That's just part of trading. That's part of life. But over the long haul, those market imperfections or volatility swings are going to feel less and less meaningless because your trade frequency is so high. And since you've cut down your risk into smaller and smaller bite-sized chunks, now you're spreading your entry out over hundreds of thousands of trades over the course of your career in this business, which only allows you to get faster results and more accurate expected results based on what you're trading. So if you're trading the 70% probability of success level, you probably won't hit 70% chance of success after 10 trades, or you may not even hit it after 20 trades. But after 1,000 or 2,000 entries, you're probably very close, if not right at 70% winners. You're going to hit exactly what you're aiming for. It just might take some time. So when we start talking about how we can apply this to options trading and how we can, use market direction to our advantage by turning things around and using trade entry a little bit different, I want to kind of walk through an example here on this podcast because hopefully it'll help out. And I don't know if you guys can tell, but I'm super passionate about this topic in general because I think a lot of people miss it. But let's assume that we enter a trade where a stock is trading at $100. And we sell the 105 call options and the 95 put options. So very simple short strangle, right? If that was our only trade, I'm just going to use the furthest end of the extreme here. If that was our only trade for the entire year, how confident would you be in placing all of your capital against that one trade? Now, we know that this trade might have, let's say, an 80% chance of success. But that's the probability if that trade was entered multiple times, hundreds of thousands of times over the course of many years. So how confident are you that this one moment, this time, this period in time becomes the time that you win on this trade versus lose big on this trade? And even though it sounds so crazy, and even as I'm describing this, hopefully a lot of you guys are thinking to yourself, I would never do that. But people do this all the time. They do this with their trades because they do it once a month, or they do, they're kind of dipping their toe in things and they try it out, they say, because they want to just try and see what it works. But they're leaving a lot up to just random chance and random probability, random sequencing of returns. So in this case, again, stock is trading $100. We sell the 105 call, we sell the 95 put. If that becomes your only trade, you're really pigeonholed into that trade working out. So here's the alternative. Let's say instead of throwing all of your eggs, all of your capital towards that one trade, you only invest 1% of your account in that trade that single day. And then let's say 2 days later, now the stock goes down to $98. So the stock has moved down by $2. You take another 1% of your account and add a new short strangle, but this time you're going to do it at new strike prices. You're going to adjust your strike prices down by $2. So now the stock has moved down by $2. You don't take anything off from your first trade, but now the stock has moved down by $2. You're going to sell the 103 call and the 93 put. So all you've done is you've adjusted your next sequential trade and you've moved with the market down. You've averaged down with the market so that now your blended, air fingers quotes, blended strike price on the call side is 104. You sold the 105, and then when the stock moved down, you sold the 103. So your blended strike price is about 104. Now you're starting to move down with the market. Now you're not going to move all the way. You don't have to overcompensate and over adjust, but you're just moving and kind of ebbing and flowing with the market. On the put side, you sold the 93 puts and the 95 puts. So your now blended average strike price is 94. And so now let's say another couple days go by and the stock continues to move down, and now it's down to 96. So it's gone from $100 to 98 to 96. So now when it's at $96, you again move your strike prices down for your next 1% entry, your next sequential entry, and you sell the 101 calls and the 91 puts. And now your blended average goes all the way down to 93 across all your strikes on the put side and down to 103 across all the strikes on the call side. And when you think about this and then try to extrapolate this out over hundreds of trades and many, many months, all we are doing effectively when we increase our trade frequency and reduce our trade size is move and ebb and flow with the market. That's why I tell people all the time, like, the market has no bearing on your ability to be successful or not in a high probability options trading, expectancy model system. Because although the market can sting if it has a huge move higher or a huge move lower, your portfolio has a better chance of recorrecting where its strike prices are with more frequent entries. So every day that the market continues to move lower, you should be moving all your positions lower. Every day that the market continues to move higher, you move all your next positions higher. This is why every single time when we look at our portfolio, we're just consistently moving around the market. I don't care where the market goes. I don't care if the market goes higher. I don't care if the market goes lower. I don't care if the market stays the same. Every day, wherever the market is, we will adjust and move our strike prices to reflect that new market price. And don't you think this is a much better approach to trading, because it's actually based on the statistics of high probability law of large numbers, than to randomly leave it up to chance and sequence of return by not entering enough positions and by scaling too high of a position size every time. I still am dumbfounded sometimes by the fact that some people do not subscribe to this methodology, even though they hear me talk about it or other people talk about it too. It's not just me. There's other very high profile traders in the past who've talked about this type of methodology, and it works because it's not based on random sequence of returns. It's accepting that we know we're not going to have, 7 out of every 10 trades be winners. We might have a string of, say, 20 losers in a row. Statistically, it's possible that could happen, right? So you set yourself up for success by reducing your trade size, by increasing your trade frequency, and you average down and around wherever the market goes. And so hopefully this helps out and kind of, again, trying to educate and help you guys make smarter decisions about how you're trading. Too many times people have so much analysis paralysis around trade entries and lots of positions and why did we do this? What's the trigger for this? Many times the trigger is nothing more than just we need to be active. Recently we made a trade and somebody asked, well, why did we do it today? And I said back to them, we did it because we had 2 other positions and now the market's higher and we needed another one. We needed to continue to ladder into more positions and just flat out be active. Because being more active can make market direction irrelevant. But when you lean on market direction, when you use it as a crutch and you don't enter a lot of positions or you don't spread out your entry across multiple entries and you just enter one position a week or one position every other week or one position every month, by default, your choice and your actions are making those entries critically important, and you're leaving it up to just random chance and random sequence of returns of whether or not you're going to be profitable. And so when you are profitable, you think you're a genius and you actually probably took too much risk. And when you're not profitable, you think that everything's broken and everything doesn't work. What the reality is you just didn't use the tools to your disposal correctly. You didn't increase your trade frequency. So hopefully this helps out. I know this was maybe a little bit more of an in-depth, higher level discussion than many of you are maybe expecting with this show. It's a podcast title today, but I do hope it helps out. And as always, if you guys have any questions, definitely let us know. There's lots of information that we're going to post around this in the show notes at optionalpha.com/show 128. Again, that's just the number 128.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hello, Kirk. Hi, this is Charles Harris. I just recently joined Options Alpha not too long ago, maybe a couple of months ago. And that was because out of all the resources that I have checked online, you are probably one of the best resources that are out there with complete details, both in formats of videos and in documents. So great job. Keep up what you're doing. I currently plan on starting trading very soon. I just opened up a couple accounts, one with Charles Schwab and one with Fidelity, just to take a look at which one I would prefer. So I have a question for you, and probably want to throw this at you, is that I want to use your Ivy Rank tool that you currently have on your site, and also join as a member. I think it's a $99 member on a monthly basis. So I want to also take a look at those two as well. So my question that I currently have is the options that you currently have placed that we have a chance to view, and those are real options. At some point, are those some that we can follow as we begin practicing or use those options, or is that just certainly dedicated to you? Because I would definitely want to try to take a look at how to put those on, how it looks, and continue to get better at trading options. So that's my question. Keep up the good work. The online seminars are great. The website information is currently great. The Axe Vault is an outstanding tool. I know years ago, I think I was taught by an options guy in the early 90s, and it's taken me that long to get back into it. My current goals are probably to trade for income and to use kind of the model that you're using, be an option seller, and use some of those credit spreads to get that done. So thanks again. Great work. Keep it up. Well, I hope you don't stop doing this at some point in time, because the information is valuable. Thank you.
Hey, Charles, man, thanks so much for submitting the question. I really appreciate it. So again, the question is, viewing and following my trades, are those helpful for others? And look, what we do on the pro and elite side of our membership is my actual trades. And so the reason I've always done this for many years is that I just wanted to have an ability to show people what we're doing, good, bad, or indifferent. I think I'm the only guy out there that has consistently done this for many, many, many years now. In fact, we post all of our trading video updates about 20 days after they go out to our members. So they go live on YouTube and for the world to see. So if we lose on a trade, we'll total it up and post it and say on a video publicly, we lost on this trade, we lost on this trade, we lost on this trade. I mean, we've had some expiration months which just have not been the best, right? Where we've had a sequence of bad losing trades and things didn't go our way. But we post all of those. So my thought process in posting my trades and sending them out to people is not necessarily that you should, trade off of those unless you want to follow what we're doing, but use all of your own analysis and make your own decisions. Those are just for educational purposes. Obviously, all the right disclosures that we have on the site. But more so than that, it's to see the cadence and the sequence and the mechanics of what we're doing. And so a lot of times when people sign up and start following what we're doing on the pro or elite side, they start to see the frequency at which we're trading and how often we're doing it and how we're adjusting and how we're managing positions and managing our emotions through a drawdown or a string of winning trades, and just recognizing that at some point we might have some losing trades. That to me is really what people should be getting out of it. The trades in and of themselves are practically meaningless unless you get the mechanics behind it. Because what I want people to be able to do once they leave the pro or elite membership is to be able to go out and do it by themselves. And that means that you're going to be trading different securities, different strike prices, different expiration dates. Nothing's going to be the same today as it is in the future. So what you need to do is you need to learn how to use and watch and follow those to then be able to do it by yourself, to learn how to fish for yourself. And so hopefully that's really what people get out of it. So they're not necessarily suggestions. They are just my actual trades. And I just publicly post those inside the group for those who are pro and elite members. So hopefully this helps out. Good question for sure today. Again, if you guys want to get your question answered here on the podcast, or live on Facebook and on our daily call podcast, please head on over to optionalpha.com/ask and click the big red button in the middle of the screen and leave me a private voicemail. Again, there's no software to download or install, and it's incredibly easy.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so on today's closing bell segment, I want to go through a trade that we just placed in OIH. This kind of goes along the lines of what we talked about in today's show about just increasing the trade frequency that we have. So we have currently a position in OIH for April expiration at the time that we're doing this. And we had another position in OIH. We had a couple actually in OIH in April, closed out of one of them in April for profit. And now we have one left over in April. But now we have to start entering new positions for the next month out for May. So what we're doing is we're entering a new position out for May. This is our first position in OIH for May. And we're just doing a simple iron butterfly strategy around where the stock is trading. So the stock is trading around $25. We're selling the 25 calls and puts and then buying options $5 out on either end, buying the 30 calls and the 20 puts. Now, why are we doing this in this case? Well, implied volatility is still generally pretty high for OIH. But buying options $5 out on either end is actually very, very cheap. We can buy the 30 calls for about 7 cents. We can buy the 20 puts for about 8 cents. It's very cheap risk reward protection for us. So it caps our risk on this thing at a $5 wide spread. And in that case, it's very cheap for us to do this. I mean, it's effectively, doing this for about like 14, 15 cents, however you get into it. And it's really, really cheap protection. We're still taking in a credit of about $2 overall net after paying for those long options. So our break-even points are about 27 on the top side and 23 on the bottom side. So we have a nice $4 range that OIH can trade in. And this is only a small set of 3 contracts that we're going to be doing because we're going to increase the laddering of this trade if OIH goes higher or goes lower. So if it goes higher to 27, then we'll add another set at 27. If it goes higher to 29, we'll add another set of 3 at 29. And we'll just continue to move and ebb and flow with wherever OIH goes from here. So hopefully this helps out. And again, is kind of a more realistic approach to tying in what we say we do on the podcast and what we're actually doing and sending out to our members.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you guys enjoyed today's show again and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training from today's show by going to optionalpha.com/show 128. Again, that's just the number 128, optionalpha.com/show 128. Until next time, happy trading.